inflation is sometimes described as too many dollars chasing too few goods. And given this definition, the inflation we've had in the past few years can be attributed to a couple of factors. Obviously, the COVID pandemic, the war in Ukraine, both of those factors have reduced the supply of goods and disrupted supply chains and those sorts of things. Then, of course, we've also had some large government stimulus packages. And of course, we've had the Fed's monetary policy of quantitative easing that increased the money supply. So it sort of sounds like you've got various factors that are affecting both the supply of goods as well as the amount of money that's chasing those goods. So from your perspective, how would you sort of divide up these factors in terms of their contribution to the inflation we've seen in recent years?
Well, that's a great question. I think number one, on the supply factor side, supply factors like we experienced with COVID and somewhat with the Ukraine do affect supply, and that may raise prices temporarily, but inflation is a continuous rise in prices. And those supply factors were eased, as we saw, as we recovered from the COVID event, and also as the war in the Ukraine stabilized and supplies were improved. So those were the so-called transitory factors that they like to talk about. On the other side of it, though, the fiscal stimulus was also, in one sense, temporary, but it was multi-year. It's still in play. So we still have the infrastructure going on. All you have to do is drive around the country and see some of the infrastructure. Other factors are the consumers were subsidized pretty heavily. That's been wearing down, but that's still a mild consideration. And thirdly, the Fed did print a lot of money. It did expand reserves enormously with COVID, and those reserves remain in play. And they have been a factor, which is why we have the continuous increase in inflation relative to the stimulus of demand coming from the printing of the money and the fiscal expenditure. So I'd say those are the more enduring parts of it, and they're still in play. The Fed is slowly trying to take the money part of it out, but it's very slowly. If you think of their quantitative tightening program, which means all those reserves they put in, they're not actually taking, they're letting the government bonds roll off. That slowly reduces the reserves, but we're still at 7 trillion, above 7 trillion. So there's still a lot of liquidity in the market that I think is facilitating the rise in prices and keeping the CPI higher than it might otherwise be. So we're a ways from that, shall we say, bringing demand back in completely aligned with supply to where we have a very low or 2% inflation rate as the Fed has targeted.